Well, good luck everyone, because it seems like things might be getting worse. At least that's what the Bank of Canada thinks, because they've seen this new report that was out this morning that confirms that their number one fear, the thing that they didn't want to see happening, is starting to happen. And while the news and data inside of this report might sound good, at least for the short term, for individuals out there, certain individuals, certain Canadians, for the Bank of Canada, this spells disaster, because it's exactly counteracting the very thing that they're trying to do right now. So in today's video, we're going to talk about what's inside of this report, why it's such a big deal that the Bank of Canada sees this right now, as well as why some of the data inside of this report could actually end up making you a little bit of money. Stay tuned for that at the end. But first, we have to talk about what this fear is that has gotten more likely of the Bank of Canada, and we've talked about it on the channel before. It's called a wage price spiral, and they're not so much afraid of the wage price spiral, but more what the wage price spiral could mean and what it could cause, and especially in terms of inflation. Right now, the Bank of Canada is really afraid of the demand in the economy, the amount of people who need to buy things, because of course that is causing more inflation, right? More people demanding more goods, not as much supply. That means that the prices of things are going to go up, which causes inflation, this track right here. That's why the Bank of Canada is currently raising interest rates so much and so quickly, is to reduce demand in the economy. Demand destruction, because higher interest rates mean people have to pay more for things like their mortgages, their car loans, which means that there's less money to go into the economy for other things, meaning that they hope that people will buy less things, and that will cause less inflation, right? We'll start to see it go down and hover around that 1 to 3% point. But it's not that simple, because they're also worried about something else. They're worried about how easy it is for people to get jobs right now, at least in the numbers that they're looking at, right? I know different people have different situations, different experiences, but currently right now we have an extremely tight labor market. That means that there's a labor shortage. There are many employers that are looking to hire more and more people. And when they realize, hey, I'm not able to hire people for the current wage that I'm charging, they're going to start raising those wages to get workers to come in and work at their at the job that they're trying to get a worker into, right? So they have to raise the wage price. So right now, this example right here, this little green circle is the wage price, and as this wage price goes up and up and up, that means that people are going to get paid more and more. And that sounds like a good thing, but to the Bank of Canada, this is the last thing they want to happen. When these businesses have to raise wages, the Bank of Canada thinks that they're going to have to increase prices more in order to sort of pay for these increased wages. And as a result, people who are getting paid this extra money will go out and spend it more on those very goods that are having the raised prices, creating more demand, right? With the same supply means that that could be an upward effect on inflation. Now, they are especially afraid of having a high inflation as a result of wage price growth or a wage price spiral, because if people start to believe that inflation is going to be here for the long term instead of just the sort of short term, and they stop believing that the Bank of Canada can get it under control, well, that is a big problem, because when inflation becomes sort of self-fulfilling, we have a big issue, right? If you think that there's going to be inflation long term, then you should buy all the things you need to buy for the long term right now, today, because everything's going to be more expensive in the future. Your dollars are going to buy less. As a result, you go out and buy everything, and that increases the demand yet again, and it sort of makes inflation, even if there wasn't going to be inflation, because of that sort of psychological effect, we have more inflation continuing for longer, and it turns into an even bigger spiral, and it becomes even harder for the Bank of Canada to control. This is their biggest fear, and the report that I'm about to show you here, well, it shows that that biggest fear isn't getting any less likely. And the report that they're looking at is the job numbers report that just came out this morning. And this has a lot of information, not just the amount of jobs added, but who is getting raises and what those raises are looking like. This is some sort of intel that you can use if you're working at a job. We're going to talk about that a little bit later, but you might be able to use this as a little bit of leverage at your employer, or use this to sort of course correct. But we're going to get into that in a second. But we see here 108,000 jobs added over month since last month. People were really only expecting that we were going to add 10,000 new jobs, but we added 10x that, 10 times that, in 108,000 jobs, a little more than 10x, right? And at the very same time, people thought that the unemployment rate might rise by 0.1%. Instead, it stayed the exact same, meaning that the same amount of people were unemployed. Now, you might be saying, Russell, this sounds like good news. There are more jobs. There are less people that are unemployed. But this is the very thing that the Bank of Canada doesn't want right now. The Bank of Canada really desperately wants to see a cooling of the labor market, not a heating up of it. They want to see it cooling, more people unemployed, less jobs available, because this means that people will feel worse about their situation and they won't go out and spend money. They don't want to see inflation for the long term. And this becomes more clear when we take a look at this report where it says that year-over-year growth in the average wages of employees, this is how much people are getting paid more this year compared to last year, remained at 5% for the 5th consecutive month, meaning that year over year, people are getting paid 5% more. Now, this still isn't more than inflation, right? We see inflation at 6.9%. That's the most recent reading. So even though people are making 5% more than they did last year, it still isn't keeping up with the rising cost of living, the very thing that the Bank of Canada is trying to fight. But it seems like these raises aren't hitting everyone equally, because we can see that depending on what you get paid kind of has an effect on how much you get raised, or how many people in your sort of pay cohort has gotten a raise in the past year. We can see here 2/3 of employees with wages above $40 per hour. This is the top 20% of all wage earners, is $40 an hour and more. They've received raises in the past year, 64% of them, nearly 2/3, right? That would be 66% would be 2/3, while only half of people who have wages of $20 and less received wages in the past year. But still, half of the people under this $20 per hour have received a wage increase, but that might not have been keeping up with inflation. It might have been only a 1%, a 2%, 3% raise, or maybe you're like in the teachers union in Ontario here, and you're having to fight for even scraps of a raise when most people who are making more than you, 64% of them have received a raise just in the past year alone. But in backwards land where good news is bad news and bad news is good news, there is some good news for the Bank of Canada, which is kind of bad news for Canadians. Take a look at this. More than 1 in 3 Canadians aged 15 and older live in households citing difficulty meeting financial needs, meaning 35.3% of Canadians over 15 are saying that it's either difficult or very difficult to make ends meet currently, to pay for food, transportation, all of the basic necessities. Now, this is bad news for individual Canadians, but it's kind of good news for the Bank of Canada, right? Because if people are feeling strapped and they're having to sort of cut their budgets and not spend as much money, this means less demand in the economy, maybe price increases will slow down, which will ultimately make things more affordable for Canadians. This is the kind of weird logic that's going on in the Bank of Canada's mind right now, thinking over the long term rather than how this situation is certainly bad for Canadians in the short term. Now, this is not the data that the Bank of Canada wants to see, especially for some of the reasons that I talked about before, but also because they've indicated that they're actually slowing down their interest rate increases, sort of saying, hey, maybe inflation is under control, maybe jobs are going to slow down, we're going to start slowing the rate at which we increase interest rates. They started with a 1% interest rate hike, then they went down to 0.75, then 0.5 this most recent time, and have indicated that even next time they might go down to 0.25. Tiff Macklem, the governor of the Bank of Canada, kind of insinuated that in some of the questioning at his last big press conference. So that is interesting to see, especially given that the Federal Reserve, which is the counterpart to the Bank of Canada in the US, the Fed they call it, obviously more important on a worldwide scale, has just increased interest rates just yesterday by 0.75. So the Bank of Canada just only raised rates by 0.5, while the Federal Reserve raised rates by 0.75, meaning that the Canadian dollar relative to the US dollar is getting a little bit weaker there, but also means that the Bank of Canada might not be able to slow down their interest rate increases as quickly as they may have thought, especially seeing this data, because when they're raising interest rates, they expect to see job numbers going down, right? Businesses can't take loans out as efficiently to hire more people. It's supposed to sort of loosen the labor market, but it seems that we still have a really hot labor market, at least with this report. Here's a key takeaway that you should have in your mind, especially if you're someone who's working at a job right now and maybe you haven't gotten a raise in a while. This is some good leverage, some good information that you could take to your employer and say, hey, most people in Canada have gotten a raise of 5% in the past year. You can see it right here. We just saw 5.6%, right, since last October. That's the amount the average salary or average hourly rate has increased. So you can take that to your employer and say, say, hey, this is just the average. Some people are getting a lot more than this, right? And in fact, 2/3, right? We talked about it before, of higher wage people are getting these raises, and the people that are making under $20 an hour are getting less, but still half of them have gotten a raise in the past year. This is all information you can take to your employer, and if they aren't too thrilled about giving you a raise of just 5%, even while inflation is at 6.9, right? You'd have a loss of wage if you didn't get a raise, or even if you got a raise of 5%. If they aren't willing to give you this raise, well, it might be time to start looking other places, because it's likely that the market rate has increased for the work that you're doing in the past year. This is especially for people who haven't received a raise in the past year. Now, this could indicate a lot of different things for people that are in different situations. If you're someone who's looking to get into the housing market, it seems like, hey, the Bank of Canada might not be slowing down rates as quickly as we thought, especially if on November 14th, I believe, we get our inflation data, and if that hasn't come down significantly, well, the Bank of Canada could keep on raising rates even more dramatically and keep them higher for a longer amount of time. Could mean that the bottom for the real estate market isn't in yet. Of course, nobody knows. No one has a crystal ball, but this is sort of a hypothesis, right? And this could also mean the same for cryptocurrency and for other investments like stocks, equities, right? Typically, we see these things moving in line with what the Federal Reserve and what the Bank of Canada does. Are they tightening or are they loosening? If they're tightening, it's bad for investments. If they're loosening, it's good for investments, right? We're looking for that pivot from when they've stopped tightening and to when they stop or start loosening, right? Because that will be better for investments, which means we could be sort of ranging sideways for the next little while when it comes to any kinds of investments. But I guess we're just going to have to buckle up as Canadian citizens and hope that the Bank of Canada can get the demand side in control, and that the government of Canada, like the federal government, can get the supply side under control, creating more supply so that we can have prolonged even inflation around 2%, 3%, where the Bank of Canada wants to see it. And we can maybe even start lowering interest rates so that people's investments can do better, jobs can do better, and we won't be scared of this wage price spiral. But with all of that said, let me know what you think about everything that we've gone over. There's a lot to cover in this video. Let me know down in the comments what you think. Is the Bank of Canada making a mistake by kind of wanting jobs to go away to reduce inflation? Or do you think that there's another route that they should be taking? Let me know down there. And of course, subscribe to the video if you haven't already done so. Like I said, investments, nobody knows where they're going to go. But over the short term, at least, I think that things will sort of stay even for the next little while unless something really dramatic happens. So if you're interested in investing in cryptocurrency or in stocks and equities, you can check out the links in the description, where there are ways that you can get up to $50 when you fund your account using those links in the description. But with all that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.